Hello everyone, welcome to OTHM Level 7 Diploma in Accounting and Finance. So now we are going to discuss Unit 1, that is about investment analysis. So we have the first learning outcome in which we will try to understand the different type of securities. So we have different type of securities. First we have bond, which is the fixed incomes which is the fixed income instrument, and it represents the loan which is made by the investor to a borrower, and it is basically with the periodic interest payment and the repayment of principal at maturity. Then we have equity. It is basically the ownership in the company, and it is represented by the share, which gives shareholder a claim on profit and voting rights. Then we have security. It is basically the tradable financial asset which includes debt instrument, equities, and derivatives, and it holds the monetary value. Now we have different type of bonds. First, we have government bonds. It is issued by the national government to finance the public project. Then we have corporate bond. It is issued by the corporation to raise capital for business operations. Then we have municipal bonds, which is issued by local governments for public infrastructure and project. Then we have zero coupon bond, and these they are sold at the discount and no periodic interest payment pays full value at maturity. Then we have convertible bond. They can be converted into a predetermined number of company shares. Now we have different type of securities. First, we have common stock, which represents the ownership, and it includes voting right and dividends based on the profitability. Then we have preferred stock, which means the priority over common stock for dividend, typically no voting right. Then we have convertible preferred stock, which can be converted into common stock, and it offers flexibility to investors. Now we have different type of securities. First, we have debt securities, which means there are bonds and other fixed income instrument. Then we have equity securities, which means there are the stocks which represents ownership in the company. Then we have derivative securities, which means there are some contracts which drive the value from underlying asset, for example, options or futures. Component. Now we have the second assessment criteria in which we evaluate key characteristic of each type of security. We have different characteristics. First we have the characteristics of bond. First we have the fixed income, which means that it provides periodic interest payment, which means coupon payments to investor. Then we have credit risk, which means there are some risk of default by the issuer, which varies with the issuer's credit worthiness. Then we have price sensitivity to interest rates, which means that bond prices move inversely to interest rate changes. Now we have the characteristics of equity. First, we have ownership rights, which means they represents the ownership in a company with voting rights, which means common stock. Then they have dividend potential, which means shareholders may receive a portion of profit as dividend. Then there is market volatility, which means that equity prices are always influenced by market condition and company performance. Now we have some characteristics of security. First, we have the liquidity, which means that securities can easily be traded in financial markets, so it means that they are liquid. Then there is the risk and return, which means that each security type offers a unique balance of risk and potential return. Then there is diversification, which means that it provides an opportunity to spread the investment risk across different asset classes. Now we have the second learning outcome, in which we try to understand the regulation of security trading and new issues in world market. So we have the first assessment criteria, in which we explain regulation and procedures that are used in trading security. Now we have some now there are financial futures. These are basically now we have now we have the second assessment criteria in which we analyze the policies and procedures relating to the trading of securities and new issues in the world market. Now we have the third assessment criteria in which we assess the issues in global market including the London Stock Exchange. So we have different derivatives. Now we have some financial options in the global market. First, we have the pricing disparities, in which there are some differences in valuation models and market assumptions. Then, if we talk about market access barriers, then there are some varying levels of market openness globally. If we talk about regulatory issues, then we have the compliance cost and complexity for cross-border trading. Then we have some global standard, which means there is the need to improve policy alignment across the countries. Now we have to discuss the London Stock Exchange. First, we have the Brexit related challenges, which means there is the equity trading and derivatives. Then we have global competition, which means competing with the exchanges like NICE and Euronext. Then we have Brexit related challenges again, which means there are some regulatory changes and loss of European market access. Then we have key issues, which means to adapt the local trading trends and maintaining the relevance. Analysis. So first we have the first assessment criteria in which we will explain the principle of investment decision. Then we have the second learning outcome in which we have to evaluate the use of securities. So we have the money market investment, which means market and invest. So first we have market in which we provide short-term funding for business and government. Then we have investor in which we have different institution, for example, bank, operation, and individual. Then we have purpose in which we facilitate liquidity and efficient capital flow in the economy. Then we have investment objective in which we seek low risk liquid investment for short-term. Needs. Now we have the third assessment criteria in which we critically assess the underlying concept of market analysis and efficiency. Now we have the money market investment. So first we have its role in the liquidity, which means there is yield and discount securities which provide the essential liquidity for investor. Then we have pricing efficiency, which examine how market mechanism influence the pricing accuracy and stability. Then if we talk about its importance, then there are some short-term securities that are vital for overall market functioning. Now we have some global disparities, which means there are the differences in regulation, market access, and transparency. If we talk about impact on investor, then it creates the challenges for cross-border investment and pricing strategies. Then there are some also market gaps, which means there are some inefficiencies which can lead to mispricing and reduced investor confidence. Now we have the fourth learning outcome in which we will try to understand the principle of taxation. So we have the first assessment criteria in which we explain the indirect and direct taxes. So if you talk about direct taxes, then these are the taxes that are imposed directly on an individual or organization's income or wealth, for example, income tax or corporate tax. But if you talk about indirect tax, then these are the taxes that are levied on goods and services, and these are passed onto the customers or consumers through higher prices. For example, sales tax or VAT, that is value added tax. Now we have the second assessment criteria in which we analyze the characteristics of indirect and direct tax. We have different characteristics of direct tax. If we talk about different type of direct tax, and first we have the income tax, which is the tax levied directly on an individual's earning or income, and its characteristic is that it is always progressive in nature, and higher income always result in higher tax rate. The second type of direct tax is the capital gain tax, and it is the tax on the profit made from the sale of asset, for example any investment or property. And if we talk about its characteristic, then it apply to the asset sale, and exemption may exist for different type of assets or threshold. The third type of direct tax is the inheritance tax, and it is basically the tax that is imposed on the transfer of wealth from deceased individuals to their heirs. And if you talk about its characteristic, then it is paid by the receipt of the inheritance, and threshold and exemptions always vary by the jurisdiction. If we talk about the corporation tax, and it is the tax on the company's profit earned during the financial year. And if we talk about its characteristic, then it is the direct tax, and it rates vary across the countries, and it always encourages compliance with financial reporting. And the fourth and fifth type of direct tax is the progressive taxation, and it is the tax rate that increase as income or wealth rises. And if we talk about its characteristics, then it is designed to reduce the income inequality, and it is common in direct taxes. Now we have some characteristics of indirect tax. So in indirect tax we have three type of taxes. First we have sale tax, which is the tax that is levied on the sales of goods and services. If we talk about its characteristic, then it is indirect tax, and it is collected by retailer and passed to the government, and it is regressive in nature. If we talk about the value added tax, VAT, that is the another type of indirect tax, then it is basically the consumption tax that is applied to the value added at each stage of production or distribution. If we talk about its characteristic, then it is the indirect tax, and it is commonly used in global market transparency through invoices. Now we have the third type of indirect tax, that is regressive taxation. It is basically the tax rate that decreases as income or wealth rises, and it is disproportionately affecting the lower income groups. If we talk about its characteristic, then it is common in indirect taxes, for example sales tax and value added tax, and it always places the higher relative burden on lower income individuals. Now we have the third assessment criterion, which we assess the principle of taxation and their implication for relevant stakeholders. Now we have the fifth learning outcome, in which we will try to understand the laws and regulations controlling the financial services industry. So we have the first learning outcome, in which we explain the laws and regulations controlling the financial service industry. So first we have different laws and regulations. So first we have the hedging, and if we talk about its nature and objective, then it always protect against adverse price movement to minimize the losses. If we talk about its regulatory oversight, then it ensures the transparency and fair trading. And if we talk about its compliance, then its rule always governs the derivative market to reduce the systematic risk. Then we have the speculation. If we talk about its nature and objective, then again it involves the taking calculated risk to profit. If we talk about its regulation, then it is limited on speculative positions to prevent market manipulation. If we talk about its market integrity, then it safeguards to ensure this safeguards and ensure that speculation does not destabilize the financial system. Now we have the arbitrage, and if we talk about its nature, then it exploits the price discrepancies between the markets. If we talk about its regulatory compliance, then arbitrage activity must adhere to anti-fraud and anti-manipulation laws. If we talk about its impact on market efficiency, then it helps to align the prices across the market. Now we have the second learning outcome in which we evaluate the range of risk mitigation method that are used in investment flow. Now we have the speculation. First, we have the speculation using future, which means it leverages the contract to profit from anticipated price changes while managing risk. Then there is the speculation using options, which mean it provide limited risk with potential for significant gains through calls and puts. Now we have the third learning outcome in which we analyze practical risk mitigation. Risk. Now we have the sixth learning outcome in which we will try to be able to understand the planning, managing, and assessing the client portfolio. Now we have the second learning outcome in which we make justified recommendation of appropriate type of savings and investment. So first we have some recommendations like fixed deposit is important, that is suitable for low risk clients seeking guaranteed returns and capital preservation. Then second recommendation is equity mutual fund. It is ideal for risk tolerant clients aiming for long term capital growth. The third recommendation is the government bond, and it is recommended for the clients that seek stable income with minimal risk. The fourth recommendation is index fund, which means passive management, and it is always best for the clients that are looking for cost effective long term returns and stable returns. Then we have the fifth recommendation, that is real estate investment trust, that is REITs, and it is the good option for the clients that seeks diversification, steady income through property investments. Now we have the third assessment criteria in which we will critically assess the issues relating to portfolio management. So we have different portfolio performance measurement. First, we will discuss its importance, that is evaluate the success of investment strategies and the efficiency of portfolio managers. It has some key metrics, for example, risk adjusted return. It measures the performance relative to the. Now we have the arbitrage pricing model, APM. Its purpose is to evaluate the asset return based on the macroeconomic factor like inflation, GDP, and interest rate. If we talk about its application, then it provides the insight into how external factor influence the portfolio performance. If we talk about its limitation, that it relies on accurate factor estimation and assume market efficiency. Now we have the issues in the portfolio management. First is the market volatility, which means there are sudden changes in market condition which can disrupt the portfolio stability. The second issue is the changing client objective, which means any evolving goal or circumstances may require frequent portfolio adjustment. The third issue is the economic uncertainty, which means different global events such as a recession or global geopolitical conflict can impact the investment outcomes. Then we have the fourth issue, that is performance tracking, which means consistent monitoring is always essential but can be resource intensive. So thank you so much. This is all about unit 1 of the level 7 diploma in accounting and finance. If you have any question, please feel free to ask. Thank you so much.